The most dangerous moments in markets are not the quiet ones. They're the moments when everyone thinks they understands what's happening. That's exactly where silver was right before it collapsed. Confidence was everywhere. Targets were spoken like facts. Risk was treated like an inconvenience instead of a force. And when a market reaches that point, it doesn't need bad news to fall apart. It only needs gravity. The crash didn't arrive slowly, it arrived all at once. 30% erased in a single session, wiping out weeks of gains and years of assumptions. That kind of move doesn't come from thoughtful decision making. It comes from a system buckling under its own weight. And when that happens, the question isn't whether the market is broken. The question is what just changed. Because something always changes after a move like that. Before the collapse, silver was priced for continuation. Momentum traders were in control. Leverage was abundant. Volatility was ignored. In that environment, even small disruptions can trigger disproportionate damage because the structure is fragile. Everyone is leaning the same way. Everyone is exposed to the same risk. When the unwind begins, there's nowhere to hide. That unwind is not a debate. It's a process. Stops fire. Margin calls arrive. Positions are closed, regardless of conviction. The market doesn't ask whether you're right. It asks whether you can pay. That's how 30% moves happen in hours. Not because the metal changed, but because the ownership did. And that ownership reset is the entire story. After a liquidation of this magnitude, the market you're looking at is no longer the same market you were trading before. The participants are different. The incentives are different. The pressure points are different. That doesn't mean the danger is gone. It means the risks have shifted. This is where most people get trapped. They assume a crash means the trend is dead, or they assume a crash guarantees a bounce. Both assumptions are lazy. Markets don't care about symmetry, they care about imbalance. And right now, the imbalance that existed before the crash is gone. Before, the imbalance was optimism. Now it's hesitation. Hesitation changes behavior. It reduces aggression. It lowers leverage. It makes participants demand better prices instead of chasing them. That alone makes downside moves harder to sustain unless new sellers emerge. And after a crash of this scale, most of the sellers have already acted. That's not bullish. That's structural. The physical side reinforces this. Despite the violence in paper prices, real-world availability didn't suddenly improve. Supply didn't rush back. Premiums didn't evaporate. That tells you the crash solved a financial problem, not a supply problem. And financial problems tend to be temporary. Supply problems tend to be persistent. This is why experienced traders talk about tactical opportunity instead of long-term certainty after events like this. They're not predicting a new bull market. They're recognizing that the odds have shifted because the easy selling already happened. The hardest part for most people is separating pain from probability. Pain feels like finality. Losses feel like truth. But markets don't care how something feels. They care how stretched it is. And after a 30% collapse, silver is no longer stretched on the upside. That doesn't make it cheap. It makes it less dangerous than it was before. Another reason this moment matters is psychological exhaustion. Extreme moves drain energy from the market. Participation drops. Volume thins. Attention fades. That's usually when markets become most sensitive to incremental demand. Not because optimism returns, but because resistance disappears. That's why rebounds after crashes often feel undeserved. They happen when nobody is confident enough to trust them. By the time confidence returns, price is already adjusted. This doesn't mean the path forward is clean. Markets that suffer this kind of damage often need time. They retest, they chop, they punish impatience. Anyone expecting a straight line back to prior highs is ignoring history. But a messy recovery is still a recovery. The real lesson here isn't about silver specifically. It's about how professionals think. They don't anchor to their last opinion. They don't defend being right. They don't confuse conviction with competence. When conditions change, they change. When probabilities shift, they shift. That flexibility is not optional in markets. It's survival. Most people do the opposite. They attach their identity to a narrative and then suffer when the market invalidates it. They stay bullish because they were bullish, or they stay bearish because being bearish feels safe after a crash. Both positions are emotional, not analytical. Right now, the emotional response is fear mixed with disbelief. That's understandable. But emotional consensus is rarely where opportunity lives. Opportunity lives in transitions, in moments when the old story is broken but the new one hasn't fully formed. In moments when risk has already been paid for but clarity hasn't arrived yet. That's where silver is now. This is not a moment for blind buying or heroic calls. It's a moment for awareness, for understanding that the market has reset its expectations, for recognizing that the worst part of the selling was mechanical, not fundamental. What comes next will depend on behavior, not headlines. Does selling fail to resume? Do dips get absorbed instead of accelerated? Does volatility compress instead of explode? Those are the questions that matter now. Because markets don't turn when everyone feels good. They turn when nobody feels comfortable anymore. And right now, comfort is gone. After a crash like this, the market enters its most deceptive phase. Not the panic, not the collapse, but the aftermath. This is the phase where nothing feels right. Price doesn't fall the way bears expect, and it doesn't rise the way bulls hope. It moves sideways, erratically, draining patience and confidence from everyone involved. And that's exactly why this phase matters. What the liquidation accomplished was not clarity. It accomplished cleansing. Excess leverage was removed. Fragile positioning was destroyed. Momentum traders who relied on stability were forced out. That doesn't end a story. It changes who gets to participate in the next chapter. The market now belongs to a different crowd. When leverage is gone, price stops reacting to fear the same way. Small sell-offs don't cascade. Headlines don't produce instant collapses. Moves require real conviction again, not just margin. That transition is subtle, and most people miss it because they're still emotionally anchored to the violence they just witnessed. This is why post-crash markets feel confusing. You're still carrying the memory of pain, but the mechanics underneath have shifted. The market is no longer as fragile as it was at the peak, even though it feels more dangerous. That contradiction is where opportunity hides. Another change that happens after extreme selling is the disappearance of overhead supply. Before the crash, every rally was an opportunity for late buyers to exit. After the crash, those same participants are already gone. They sold in panic or were forced out. That means rallies don't face the same resistance they did before, even if confidence hasn't returned. This doesn't guarantee a rally. It removes an obstacle. The physical side continues to be the quiet confirmation. Despite the destruction in paper prices, availability didn't suddenly improve. That tells you real holders were not the ones selling. The selling was financial, not physical. And financial selling has an expiration date. Physical imbalances don't. This is why markets often rebound when they feel least deserved. Not because conditions improved, but because pressure disappeared. But rebounds are not trends, they're tests. The market will test whether buyers are willing to step in without being chased by leverage. It will test whether sellers are truly exhausted. It will test whether volatility can compress without exploding again. These tests take time, and they rarely resolve cleanly. Anyone expecting immediate confirmation will either chase too late or exit too early. That's how the market extracts its toll after crashes, not through speed but through ambiguity. Another mistake people make is assuming that because something crashed, it must be cheap. Price and value are not the same thing, especially after forced selling. The right question is not whether silver is cheap, but whether the risk of owning it has changed relative to the risk of not owning it. Before the crash, the risk was being long in a crowded trade. After the crash, the risk shifts toward missing a move that happens without warning. That doesn't mean buying recklessly. It means recognizing asymmetry. Asymmetry is the entire game. You don't need certainty to act. You need odds. And after a liquidation of this scale, the odds are no longer one-sided in the direction they were before. This is also where time horizon becomes critical. Short-term traders and long-term investors are not playing the same game. What looks like chaos on a 5-minute chart can look like structure on a weekly one. Confusing those perspectives leads to bad decisions. Professionals survive because they know which time frame they're operating in and refuse to mix them emotionally. They don't expect long-term investments to behave like day trades. They don't expect short-term trades to respect long-term narratives. That separation is discipline. What the legendary traders demonstrated by flipping their stance was not confidence in a specific outcome, but respect for changing conditions. They recognized that the reasons to be aggressively bearish no longer existed after the crash. That doesn't mean reasons to be aggressively bullish suddenly appeared. It means the middle ground reopened. Markets are most dangerous when the middle ground disappears. That's when everyone is forced into extremes. Crashes restore the middle ground by destroying extremes. This is why the aftermath often feels anticlimactic. You expect drama, you get indecision, you expect direction, you get noise. But beneath that noise, structure is being rebuilt. The real risk now is not volatility. It's impatience. Impatience leads people to force trades where none exist. It leads them to interpret every tick as confirmation. It leads them to overcommit emotionally when the market is still undecided. The smarter approach is observation. Watching how price behaves when fear subsides. Watching whether dips accelerate or get absorbed. Watching whether volatility contracts or re-expands. These behaviors tell you far more than any prediction ever could. What just happened was historic. But history is not destiny. It's context. The crash reset expectations. It reset positioning. It reset psychology. Those resets don't announce the next move. They make it possible. And markets don't reward people who demand certainty. They reward people who can operate when certainty is absent. That's where we are now. The violence is over. The questions are just beginning.